You are watching the most important financial shift in modern history unfold in real time. What I am about to show you will change everything you think you know about gold, about banks, and about where the smart money is actually going. Because right now, as we speak, Goldman Sachs, Morgan Stanley, and the largest financial institutions on Earth have just moved $380 billion into physical gold vaults. Not paper, not futures, not ETFs, physical metal sitting in secured vaults. And this is just the beginning. Tomorrow marks a critical inflection point that nobody in the mainstream media is talking about. The institutional rebalancing cycle for January 2026 is about to accelerate in ways that will leave most investors completely blindsided. Let me walk you through exactly what is happening, why it matters, and what you need to understand before the window closes. For decades, gold was dismissed by Wall Street. They called it a barbarous relic. They said it was dead money. They told you that bonds were the safe haven, that treasuries were the ultimate store of value. But here is what they never told you while they were saying all of that. They were quietly, systematically, relentlessly accumulating physical gold, and the numbers are staggering. Goldman Sachs just raised their gold price target to $4,900 per ounce by the fourth quarter of 2026. This is not some fringe prediction from a gold bug on the internet. This is Goldman Sachs, the most powerful investment bank on the planet. And they are not alone. Morgan Stanley has done something unprecedented. Their chief investment officer has publicly recommended a 20% allocation to gold in investor portfolios. Think about what that means. The traditional financial industry has spent 50 years telling you that 5% in gold was extreme, that 10% was for doomsday preppers. And now Morgan Stanley is saying 20%. This is not a subtle shift. This is a complete reversal of everything Wall Street has told you about portfolio construction for half a century. But actions speak louder than recommendations. And the action is what should terrify you if you are not positioned correctly. JPMorgan has issued the most aggressive target of all. They are forecasting $5,055 per ounce as the average by the fourth quarter of 2026. And they see potential scenarios where gold could hit $6,000 per ounce by the end of the Trump term. Bank of America has raised their forecast to $5,000. UBS is targeting $3,800. State Street Global Advisors sees gold consolidating between $4,000 and $4,500 before potentially breaking to $5,000. Every single major institution is raising targets. Every single one. And this is happening while the price has already surged 71% in 2025 alone, the largest annual gain since 1979. But here is where it gets really interesting. And this is the part that the financial media is completely missing. These banks are not just raising price targets. They are physically moving metal, real gold, into real vaults. And they are doing it at a pace that is straining the entire global bullion infrastructure. The London vault drainage is happening right now. In January 2025 alone, 4.9 million troy ounces flowed out of London vaults. That is the largest monthly decline since 2016. And it has not stopped. The Bank of England, which has operated with clockwork precision for centuries, has seen its delivery times extend from a few days to 4 to 8 weeks. Let that sink in. The Bank of England, the institution that has defined reliability in precious metals for hundreds of years, cannot deliver gold in normal timeframes anymore. This is not a minor logistics issue. This is a fundamental shift in how the physical gold market operates. The LBMA vault inventory has dropped 3% between October 2024 and January 2025. That might sound small until you realize what it represents. We are talking about nearly 200 tons of gold leaving London. And we are talking about a delivery backlog of 380 million ounces that the system is struggling to process. The fractional reserve model that has defined bullion banking for decades is breaking down in real time. The just-in-time inventory model that worked when nobody wanted physical delivery is collapsing under the weight of actual demand. Let me explain why this matters so much. For decades, the gold market operated on a simple assumption. Most holders of gold paper, whether ETFs or futures or unallocated accounts, would never actually demand physical delivery. The banks could sell the same ounce of gold to multiple parties because they knew that most of those parties would simply trade the paper back and forth. They would never actually want the metal. This is how fractional reserve bullion banking worked. And it worked beautifully until it did not, because now central banks want the metal. Institutions want the metal, sovereign wealth funds want the metal, and suddenly the game of musical chairs, where there were always more claims than actual gold, is becoming very dangerous for those left standing when the music stops. Central banks have purchased over 1,000 tons annually since 2022. That is double the decade average before that period. In the first quarter of 2025 alone, net purchases were 244 tons. In the third quarter, another 220 tons. Central bank demand is now accounting for over 40% of total gold demand globally. And here is the truly remarkable part. By the end of 2025, gold reserves exceeded U.S. Treasury holdings in global central bank portfolios. Read that again. For the first time in modern monetary history, central banks are holding more gold than American government debt. This is not a vote of confidence in the dollar. This is the opposite. This is the world quietly but unmistakably saying that they no longer trust paper promises, backed by nothing but faith. The BRICS nations have increased their gold share from 6.4% to 12.9% of reserves just by the third quarter of 2025. China, Russia, India, Brazil, South Africa, and the growing list of nations seeking membership. They are all accumulating gold at unprecedented rates. This is not speculation. This is documented central bank purchasing that you can verify yourself through World Gold Council statistics. The de-dollarization trend that Western media dismissed as fantasy is happening in real time, and gold is the asset they are accumulating to replace dollar exposure. Now, let me address the ETF situation because this is crucial for understanding the January 2026 catalyst. For 4 consecutive years, gold ETFs experienced outflows. Money was leaving. The financial media used this as evidence that gold was dead. They pointed to the outflows and said, "See, nobody wants gold anymore. Smart money is selling." But here is what they did not tell you. Those outflows were actually setting up one of the most powerful restocking cycles in ETF history. In 2025, everything reversed. The current ETF restocking cycle is now at 77 weeks, with 825 tons accumulated. For context, the first major cycle saw 1,823 tons accumulated over 221 weeks. The second cycle saw 2,341 tons over 253 weeks. We are only 77 weeks into this cycle. The mathematics suggest we have potentially years of continued accumulation ahead. Record quarterly ETF inflows of 222 tons in the third quarter of 2025 represent the biggest quarterly inflow in years. North American funds are leading global ETF demand with $334 million in inflows even on the market's worst single day. India alone has seen ETF inflows increase 5.5 times versus all of 2024, with 123 tons accumulated year to date. And crucially, global ETF holdings are still below their November 2020 all-time high. There is significant room to run before we even approach previous peaks. January 2026 represents a critical inflection point for several reasons. First, institutional rebalancing cycles accelerate at the start of each calendar year. Asset managers reset allocations. Pension funds adjust portfolios. Sovereign wealth funds implement new mandates. This creates concentrated buying pressure precisely when liquidity is thinnest. Second, the Federal Reserve guidance in January will signal the path of interest rates for 2026. Expected rate cuts provide powerful support for gold because they reduce the opportunity cost of holding a non-yielding asset. Third, Chinese New Year demand traditionally peaks in January and February. Cultural gold purchasing creates additional physical demand pressure precisely when Western institutional buying is also accelerating. But here is what nobody is talking about: the physical supply constraints. The time it takes to source, refine, and transport physical metals has extended significantly. Mining production is constrained by development delays that take 7 to 10 years to address. Environmental regulations are making new production more difficult and expensive. Energy costs are squeezing mining margins. And refinery bottlenecks mean that even when gold is mined, the process of turning raw ore into deliverable bars faces its own capacity limitations. The backwardation signals in the market are telling. Backwardation occurs when spot prices trade higher than futures prices. This is unusual because gold normally trades in contango, where futures prices exceed spot due to storage and financing costs. When backwardation appears, it indicates that immediate physical demand exceeds available supply. People are willing to pay a premium to get gold now rather than later. This is happening with increasing frequency. And it is a warning sign that the paper market and the physical market are beginning to diverge in ways that could create extraordinary dislocations. Let me walk you through what this means operationally for the banking system. Vault capacity limitations are restricting inventory expansion capabilities. The LBMA accredited vault space that institutional players require is facing waiting lists extending months into the future. Private vault operators are expanding capacity as fast as they can, but construction takes time. Meanwhile, transportation and insurance costs for physical metal holdings are rising substantially. Moving gold is expensive and risky. The costs compound when you are moving large quantities under tight security protocols. Banks are responding to these constraints in several ways. They are restricting new physical product clients. If you are not already an established customer with physical allocation agreements in place, good luck getting one now. They are increasing margin requirements for leverage positions to reduce their exposure. They are extending delivery timeframes for non-priority clients to months rather than days. They are competing with other institutions for increasingly scarce LBMA-accredited storage space. Geographic arbitrage patterns are also emerging. Increased shipments from London to New York COMEX approved warehouses indicate that metal is moving to where delivery obligations are most pressing. Private vault operators are expanding capacity in both locations simultaneously. Central banks are adjusting their storage location preferences based on supply constraints and geopolitical considerations. Retail product shortages in smaller denomination bars and coins are experiencing severe supply pressure even as institutional volumes move at premium pricing. The implications of this extend beyond gold itself. The $5,000 scenario that multiple major banks are now forecasting is not fantasy. Morgan Stanley, Goldman Sachs, and JPMorgan all see continued rally potential through 2026 and into 2027. The Federal Reserve easing that markets expect will drive continued ETF buying. Geopolitical premiums from U.S. political uncertainty, and BRICS de-dollarization initiatives are adding structural demand that will not disappear with a single news cycle. The long-term shift away from dollar-denominated reserve assets is a generational trend that will play out over years and decades. VanEck is forecasting potential $5,000 per ounce by 2030 as part of this structural trend. But events are accelerating faster than many models anticipated. What was supposed to take 5 years is happening in 2. What was supposed to be gradual is becoming compressed. The 71% gain in 2025 was not supposed to happen according to traditional models. Gold was supposed to be boring, steady, slow. Instead, it has delivered the largest annual return in over 40 years. For retail investors, this creates both opportunity and urgency. The physical versus paper decision has never been more important. Banks are prioritizing physical metal. Should investors follow that signal? The delivery delays that institutions face will eventually trickle down to retail availability. When the London bullion market is struggling to meet institutional demand, the local coin dealer is not going to have endless supply either. The timing considerations are critical. The ETF restocking cycle has significant room to run based on historical patterns. But windows like this do not last forever. Supply scarcity premiums are already beginning to emerge. The spread between paper prices and actual physical purchase prices is widening. This gap will likely increase as demand accelerates and supply struggles to keep pace. Morgan Stanley's 20% recommendation versus the traditional 5 to 10% allocation represents a massive paradigm shift. If even a fraction of global investment capital attempts to move toward that allocation level, the supply-demand mathematics become explosive. There simply is not enough gold in existence to accommodate that kind of reallocation at current prices. Prices must rise to balance the equation. This is not speculation. This is arithmetic. Now, let me address something that I know many of you are thinking. What about the risk factors? What could go wrong with this thesis? I'm not here to sell you blind optimism. I'm here to help you understand reality. And reality includes risks. Rapid disinflation could undermine the gold thesis. If inflation falls significantly below 2%, gold loses some of its appeal as an inflation hedge. This would likely trigger a 10 to 15% price correction. Real rates rising could also pressure gold. If the Federal Reserve maintains higher rates longer than expected, the opportunity cost of holding gold increases. This could depress prices 10 to 20% from current levels. Geopolitical de-escalation, while unlikely, could reduce the risk premium currently embedded in gold prices. And retail sentiment reversal. If technical breakouts fail at psychological levels, could trigger tactical pullbacks. But here's what I want you to understand about these risks. They represent potential short-term volatility, not fundamental threats to the structural thesis. Central bank diversification is a multi-decade trend. De-dollarization pressures will not reverse because of a single political development. Supply constraints in mining are physically real and cannot be addressed quickly. The paper-to-physical disconnect is mechanical, not psychological. These forces will continue, regardless of short-term price movements. The question is not whether gold will continue its structural advance. The question is whether you will be positioned before or after the next major leg higher. Because here is the mathematical reality that Wall Street understands, even if retail investors do not. When institutional money decides to move, it moves fast, and it moves in size that overwhelms available supply. The $380 billion that has already moved into physical gold vaults is just the beginning. There are trillions more in institutional capital that is currently underweight gold based on the new allocation frameworks being recommended. Think about what happens when pension funds managing trillions attempt to move from 2% gold allocation to 10%. Think about what happens when sovereign wealth funds managing hundreds of billions increase their gold weighting. Think about what happens when family offices and high net worth individuals follow the Morgan Stanley 20% recommendation. The incremental buying from these allocation shifts dwarfs anything retail investors can generate. And it will be buying physical metal, not paper, because that is what the smart money has figured out. Paper gold only works when you never have to take delivery. And the institutions are increasingly demanding delivery. The vault drainage will continue. The delivery delays will extend. The price targets will keep getting revised higher as reality exceeds forecasts. Goldman has already moved from their original projection. They will move again. JPMorgan has already staked out 5,000 plus territory. Others will follow. The consensus is shifting in real time. And consensus shifts in financial markets tend to overshoot in both directions. This is not the time for analysis, paralysis. This is not the time to wait for perfect entry points. This is the time to understand what the largest financial institutions on earth are doing with their capital. They are moving into physical gold at a pace that is straining global infrastructure. They are raising price targets to levels that would have been dismissed as fantasy just 2 years ago. They are recommending allocation levels that represent a complete reversal of decades of portfolio theory. The exodus from paper to physical has begun. The central bank buying frenzy shows no signs of slowing. The supply constraints are structural and cannot be fixed quickly. The geopolitical catalysts are multiplying, not diminishing. And January 2026 marks the beginning of an institutional rebalancing cycle that will intensify every factor I have just described. Tomorrow is not a metaphor. It is a reality that institutional portfolio managers are preparing for right now. The question is whether you will be prepared alongside them, or whether you will be watching from the sidelines as the greatest wealth transfer in precious metals history unfolds in front of you. The data is clear. The institutional positioning is documented. The price targets are published for anyone to read. The vault drainage is measurable. The delivery delays are verifiable. This is not conspiracy. This is not speculation. This is what is actually happening in global gold markets right now. And what is happening is that the smart money has made its decision. $380 billion into physical vaults. With more to follow, the only question remaining is what you will do with this information.